The Canadian telecom giants are in an absolute depression right now, in some cases worse than the '08 financial crisis and even the dot-com bubble. And we got to ask ourselves, are these assets becoming toxic, or are these monopolies, because we do not allow foreign telecom providers to come into Canada, are these monopolies continuing to have a foothold that will prove resilient over long periods of time? That is the question we have to ask ourselves, but I would not treat every one of these telecom giants as an equal. They have far different assets spread across them, and some are far more toxic than others. Starting off with Bell, who has not posted earnings yet, but Q1 earnings, I think, are going to be another defining factor to how far this stock drops. I mean, look at the absolute calamity. This thing is down 58% now, almost 60% from top to bottom. It did not drop this hard in the 2008 financial crisis or the dot-com bubble. The dividend that every investor has been screaming they should cut, they should take that cash flow and rebuild their balance sheet, but they know that that would only further detriment the holders of this telecom provider, because a lot of people just hold it for the dividend. I think management thinks if we cut the dividend, we're going to see this thing absolutely crater. So what they did in the meantime is they said, hey, we're going to offer a dividend reinvestment plan where if you reinvest the dividend, we're going to give you a discount on some shares, and that allows them to retain the capital, which seems a bit foolish. I really think they should have just cut the dividend, because if we dive a bit deeper into this, we're going to understand that basically the higher interest rate environment absolutely crushed these infrastructure companies. It's why I've been calling them interest rate recovery plays. But you also have the fact that Bell is a heavily media-oriented company that invested thoroughly throughout Canada's media division, realizing it was quite a mistake as everyone shifted to social media, and they shifted a lot of their media division to Crave. And Crave has been quite resilient for them, but I hate media. It is very costly. This is why I don't like Netflix and all these other streaming providers. You really just want to own YouTube. YouTube doesn't pay for any content. I would rather Bell just strip all of those assets and be a pure telecom provider, but we're also going through infrastructure upgrades, right? We're looking at fiber optics. They're moving from the traditional copper lines, and a lot of this has been very, very costly, and with the higher interest rate environment that has only just started to subside, it is what's led to this absolute destruction of the stock price, right? Because the company has a lot of debt, $56 billion, $73 billion in current assets, and if we compare it to the current earnings, what's great is that these companies, as mentioned, you're not going to stop paying your phone bill, your internet bill, so the revenue has actually been quite sustainable, which I think is a shock to a lot of people. It has been trickling to the downside, but overall, it has been quite strong. It's just the bottom line that has been deteriorated quite dramatically. We can see that in the net earnings per share here being 18 cents for the entirety of 2024 versus $2.28. Currently, the net earnings, even if you look at the adjusted EPS, I mean, the company's currently paying out what, $1 in dividends, and its entire adjusted EPS is 79 cents. So they can't afford the dividend. Everybody's been screaming that from the top of their lungs, and the company's been doing everything again in order to not cut the dividend. They're issuing more debt to basically get them through this tricky environment. They literally are pushing out a crazy amount. I mean, $1.13 billion in debt that's due in 2050 to help them kind of get through this more rocky period. And the question we really got to ask ourselves, are they going to be able to get through this, or is the company going to go through a complete restructuring of their assets? It's going to be an interesting conversation to be had, and I'd love to know what you guys think. Bell has always been my least favorite telecom provider, and we're going to talk about the more favorited here, starting with Rogers. Rogers, I think, is just being taken down with the whole sector. It's down 52%. Is it worse than the '08 financial crisis? Probably close to in line, maybe a bit worse. But yeah, we're literally in a 2008-like event for these companies. Honestly, the price to earnings ratio has been a bit more adjusted with the recent earnings they posted, and the dividend yield is actually looking quite sustainable here, though I will say the company is paying out pretty close to its income, but it actually has more debt than Bell does, which is quite interesting. Their debt to assets are still pretty heavily debted. I mean, they got $10 billion in assets, so keep in mind these companies aren't even trading it to their underlying NAV or their asset values, so they're still trading at quite a premium. Not that the stocks will drop because of that. You can't really take NAV as a total cost of the business. It's not like REITs, but nonetheless, if we dive a bit deeper into here and we actually take a look at the recent earnings that just came out, we can see that their total revenue has actually gone up by 2%. Their total service revenues have actually increased. Their net income starting to go up actually by 9%, which is great to see. Adjusted net income basically unchanged for the most part, but their diluted earnings per share 50 cents, adjusted earnings at 99. So they can actually afford the dividend that they have here because their dividend is currently 50 cents. So Rogers is actually looking pretty strong, especially with these sporting events. They own a sporting event industry, which basically I think they bought some of those assets from Bell. When it comes to, I don't really watch a whole lot. I'm sure a lot of people are watching the Maple Leafs right now, a lot of hockey. So it seems to be working out for them in that aspect. Free cash flow remaining roughly flat here, but still, I'm very shocked that if we read into the the CEO's comments, in the first quarter we delivered positive revenue and adjusted EBITDA growth while growing mobile phone and internet net additions against the backdrop of the slowing economy. We are executing with discipline, deleveraging our balance sheet ahead of schedule, and making strategic investments to drive long-term growth. Rogers is actually proving to be quite strong here, and the next in line would be Telus. I still think Telus has been one of the most resilient companies. We see it in their stock price. I think it's the diversification of the businesses they have, but all of these telecom providers right now are operating on the bleeding edge of their payout ratios, their dividends. These restructuring costs are absolutely killing them, and these are new periods where they really need to show that they can sustain. And I think Rogers is proving that they can sustain on the back of even immigration cuts. There's a lot of pressures on these companies. So if we dive a little bit deeper into Telus, which right now is trading down about 38% from its highs, it looks like it's starting to find a bit of a bottom here. It is still on the bleeding end of its payout ratio because currently the dividend is about 40 cents, but we can see their adjusted earnings per share is 25, but you got to take into consideration some depreciation, amortization costs that do play into all of these infrastructure companies. If you look at cash flow, they are pretty much on the bleeding edge, right? Like their payouts on mostly all of these companies, all of these companies could do to cut their dividend if they wanted to bolster some more of their cash instead of utilizing debt in some cases like Bell. But again, this company is still seeing telecom subscriber growth, which again, I would like to see Q1, but because Rogers is proving strong, it'd be neat to see if they're still seeing quite this level of growth. But even with their healthcare, when their telecom or their telehealth sector is seeing double-digit growth, like I said, I think these companies are still great companies. It's just a matter of, are you willing to ride through this absolutely absurd volatility, right? Because again, I mean, Telus is investing in the future. They launched a sovereign AI factories, basically partnering with NVIDIA from my understanding. So they're investing in some of their cloud computing centers. Lots going on here, and I think Telus and Rogers are proving to be the outliers that could actually sustain through this without cutting the yields. Though I think, if you are a prudent investor, again, I'm a total return-oriented investor, and I don't think dividends should be the core focus of all companies, but I think they want to hold on to these because they know the core aspect of their investors are relying on these dividends, and they are pretty big weightings. I mean, they've been de-weighted, but they're still heavy in a lot of these Canadian dividend ETFs. So yeah, it'll be neat to see how this sector performs coming Q1 and Q2, but this is a defining factor now that we have lower interest rates. So it'll be neat to see this combination of less immigration but lower interest rates, the restructuring that we're now starting to put behind us in some cases. Telus, Rogers, I mean, they're in the midst of it, kind of getting to the other side, whereas Bell, I still think, is in the midst of a horrific restructuring, having to issue more debt. It is a wild time for these companies, but I am not really buying them outside of what is being held within my dividend ETFs that I hold, which is luckily market cap weighted. Like VDY is a market cap weighted dividend ETF, so these will slowly de-weight their way down, based off the performance, which right now has been abysmal, which we haven't really been seeing in VDY, which is nice because again, this is why I think market cap weighted ETFs are so prevalent. I mean, if you look at VDY, it's starting to pressure back toward all-time highs, but it does give me exposure to some of these telecom giants. So yeah, really intrigued by how this is going to play out. It's a really peculiar time for telecom giants. But I'll pass the question off to you. Are you buying these? I did sell Telus. I held it individually. I still think it's the strongest of the bunch. Could be in a recovery, but nonetheless, I did transfer it over into the S&P because the S&P dropped so much, and I still see more resilience in some of the technology sectors in the United States. But yeah, let me know what you think in that comment section below.